Hi, and welcome to Module 6, Investment Advisor. This module introduces the fundamental concepts of investment principles, which are crucial for effective financial planning and decision-making. In this module, we will cover general investment principles, pre- and post-retirement planning, tax implications for investments, as well as all types of investments portfolios. Learning Unit 1, General Investment Principles. Introduction. This unit introduces the fundamental concepts of investment principles, which are crucial for effective financial planning and decision-making. It covers a comprehensive overview of the six-step financial planning process, needs analysis, investment goals, and the essential elements of a solid financial plan. The unit also delves into basic investment principles, the impact of legislation on these principles, and the various risks associated with investments. Understanding asset classes and their corresponding risks is also covered, leading to the application of these principles in creating a sound financial solution. 1.1. The six-step financial planning process. The six-step financial planning process serves as a structured approach to managing an individual's or entity's financial situation. It involves establishing and defining the client relationship. This step is about building a rapport with the client and understanding their financial aspirations. Gathering client data, including goals. Collecting all relevant financial information and understanding the client's short-term and long-term goals. Analyzing and evaluating the client's financial status. Assessing the current financial situation to identify strengths and areas for improvement. Developing and presenting financial planning recommendations and/or alternatives. Creating a plan that aligns with the client's goals and financial status, offering different options for consideration. Implementing the financial planning recommendations, putting the agreed-upon plan into action. Monitoring the financial plan. Continuously reviewing and adjusting the plan to ensure it remains aligned with the client's goals and changing circumstances. 2. Needs analysis and investment goals. Understanding a client's financial goals involves evaluating their current financial position, income, assets, liabilities, determining future needs, retirement, education, assessing their risk tolerance, how much risk they can handle, considering their investment time horizon, short-term versus long-term, setting clear, realistic investment objectives. 3. Elements of a solid financial plan. A good financial plan should include comprehensive analysis of the client's situation, clear objectives that are realistic and achievable, diversification to spread risk across different investments, liquidity to ensure access to cash when needed, tax efficiency to minimize tax liabilities, regular reviews to keep the plan up to date. 4. Basic investment principles. Key investment principles include time value of money. Money today is worth more than the same amount in the future. Compounding. Earning returns on both the original investment and accumulated returns. Diversification, spreading investments to reduce risk. Risk-return trade-off. Higher potential returns come with higher risk. Dollar cost averaging, investing regularly to smooth out market volatility. 5. Impact of legislation. Legislation affects investments through regulatory frameworks that govern financial markets, compliance with legal requirements, taxation laws that impact returns, consumer protection to prevent fraud and unfair practices. 6. Risks associated with investments. Investments carry various risks. Market risk, fluctuations in the overall market. Credit risk, risk of default by a borrower. Liquidity risk, difficulty in selling an asset quickly. Inflation risk, erosion of purchasing power. Interest rate risk, impact of changing interest rates on investments. 7. Asset classes and risk. Different asset classes include equities, high potential returns but higher risk. Bonds, fixed income but sensitive to interest rates. Real estate, steady income and potential appreciation but less liquid. Commodities, physical assets that can hedge against inflation but are volatile. Cash equivalents, stable but low returns. 8. Principles of investment and a financial solution. Finally, these principles guide the creation of a financial solution that applies investment principles to build a diversified portfolio, aligns with client goals and legal requirements, incorporates continuous monitoring to adapt to changes in the market or client situation. In summary, this unit covers how to systematically approach financial planning, assess investment needs, manage risks, and create a well-rounded financial plan that adapts over time. Learning Unit 2, Pre- and Post-Retirement Planning. Introduction. This unit focuses on the essential aspects of planning for retirement, both before and after the retirement phase. It covers the factors that influence a comfortable retirement, the role of annuities, how annuity rates affect retirement planning, and the principles of behavioral finance, which impact financial decision-making during retirement. 2.1. Aspects impacting on comfortable retirement. Comfortable retirement is influenced by several key factors: savings and investments. The amount saved during the working years directly affects retirement comfort. Cost of living. Understanding future living expenses, including healthcare, is crucial. Retirement age. The age at which one retires impacts the duration that retirement savings need to last. Inflation. The rising cost of goods and services over time can erode the purchasing power of retirement savings. Longevity. As people live longer, they need more savings to sustain a comfortable lifestyle throughout retirement. 2.2. Annuities. Annuities are financial products that provide a steady income stream during retirement. Types of annuities. These include fixed annuities, which offer guaranteed payments, and variable annuities, where payments can fluctuate based on investment performance. Purpose of annuities. They are designed to provide financial security by converting a lump sum into a reliable income stream for life or a specified period. Annuity options. Options like lifetime annuities, which pay out for the retiree's entire life, can be crucial in retirement planning. 2.3. Annuity rates and their impact on retirement planning. Annuity rates are critical in determining the income retirees receive. Interest rates. Annuity rates are often tied to prevailing interest rates, with higher rates typically providing better payouts. Timing of purchase. The age and timing when an annuity is purchased can impact the rate, with older individuals often receiving higher payments. Inflation-adjusted annuities. These offer payments that increase with inflation, protecting purchasing power over time. Impact on retirement income. Understanding how these rates affect retirement income helps in making informed decisions about when and what type of annuity to purchase. 2.4. Understanding behavioral finance. Behavioral finance explores how psychological factors affect financial decision-making. Cognitive biases. Retirees may exhibit biases like overconfidence or loss aversion, which can impact their investment choices. Emotional influences. Emotions like fear or regret can lead to poor financial decisions, such as selling investments during market downturns. Decision-making in retirement. Understanding these behavioral tendencies can help retirees make more rational and beneficial financial decisions, ensuring their retirement plan remains on track. In summary, this unit emphasizes the importance of strategic planning for retirement, with a focus on understanding the impact of annuities, annuity rates, and the role of behavioral finance in making sound financial decisions both before and during retirement. Learning Unit 3, Tax Implications for Investments. Introduction. This unit examines the tax implications that affect various investment strategies and financial planning. It provides an overview of the Income Tax Act and its impact on long-term insurance, medical aid schemes, and different investment instruments. The unit also delves into the taxation of dividends and explains key concepts in capital gains tax, CGT, highlighting how these taxes can influence investment decisions. 3.1. The Income Tax Act and long-term insurance. The Income Tax Act outlines the tax treatment of long-term insurance products, such as life insurance policies and endowments. Tax deductibility. Certain premiums, particularly those for policies providing income protection, may be deductible from taxable income. Proceeds taxation. The tax treatment of payouts from life insurance policies varies depending on the type of policy and the circumstances under which the benefit is paid. Policyholder benefits. Understanding how these policies are taxed is crucial for effective financial planning. 3.2 The Income Tax Act and medical aid schemes. The Income Tax Act also impacts medical aid schemes and the tax treatment of contributions and benefits. Tax credits. Contributions to approved medical aid schemes may qualify for a tax credit, reducing the overall tax liability. Medical expenses. Out-of-pocket medical expenses that exceed a certain threshold can be claimed as deductions, further reducing taxable income. Impact on retirement planning. The tax treatment of medical aid contributions and expenses is a vital consideration for retirees and those planning for retirement. 3.3. The Income Tax Act and investment instruments. Different investment instruments are subject to various tax implications under the Income Tax Act. Interest income. Interest earned on savings and fixed income investments is generally subject to income tax. Tax-free savings accounts, TFSAs. Contributions to TFSAs are made from after-tax income, but the interest, dividends, and capital gains earned within these accounts are exempt from tax. Retirement annuities. Contributions to retirement annuities are tax-deductible up to a certain limit, and the growth within these funds is tax-deferred until retirement. Unit trusts. The tax treatment of income and capital gains from unit trusts depends on whether the investor receives dividends, interest, or capital gains. 3.4. The taxation of dividends. Dividends received from investments in shares are subject to dividend withholding tax, DWT. Withholding tax. Typically, dividends are subject to a withholding tax, which is deducted by the company paying the dividend before it is distributed to shareholders. Tax-free dividends. In some jurisdictions, dividends paid to certain entities, such as retirement funds, may be exempt from tax. Impact on investment strategy. Understanding the taxation of dividends is essential for investors aiming to maximize after-tax returns. 3.5 Concepts in capital gains tax, CGT. Capital gains tax, CGT, applies to the profit made from selling an asset for more than its purchase price. And CGT inclusion rate. Only a portion of the capital gain is included in taxable income, depending on the taxpayer's classification, individual, trust, or company. Annual exclusion. There is often an annual exclusion amount, below which capital gains are not taxed. Base cost. The original purchase price or valuation at the time of acquisition forms the base cost, which is subtracted from the sale price to determine the capital gain. Impact on investment decisions. CGT considerations are critical when deciding when to sell assets, as the timing can significantly affect the tax liability. In summary, this unit highlights the importance of understanding the tax implications associated with various investments. It covers the Income Tax Act's impact on long-term insurance, medical aid schemes, and investment instruments, along with the taxation of dividends and capital gains. These concepts are essential for effective tax planning and maximizing the after-tax returns on investments. Learning Unit 4, Investment and Portfolio Management. Introduction. This unit delves into the core principles of investment and portfolio management. It covers key concepts like return on investment, ROI, the time value of money, TVM, investment returns, and risks. Additionally, it explores important financial theories such as the Capital Asset Pricing Model, KPM, and Arbitrage Pricing Theory, APT. The unit also examines different portfolio management techniques, investment styles, and compares single asset management to a multi-manager approach. 4.1. The concepts of return on investment and time value of money. Return on investment, ROI. ROI measures the profitability of an investment, expressed as a percentage of the initial investment cost. It's a crucial metric for comparing the performance of different investments. Time value of money, TVM. This concept states that money available today is worth more than the same amount in the future due to its potential earning capacity. TVM is foundational in calculating present and future values of cash flows, helping investors assess the value of investments over time. 4.2. The investment return. Investment return refers to the gain or loss generated by an investment over a specified period. It can be in the form of capital gains, the increase in value of an asset or investment, dividends, income received from equity investments, interest, income earned from bonds or other fixed income instruments, total return, the overall return on an investment, combining capital gains, dividends, and interest. 4.3. The investment risk. Investment risk is the possibility of losing some or all of the original investment. It includes market risk, the risk of losses due to changes in market prices. Credit risk, the risk that a borrower will default on their obligations. Liquidity risk, the risk of not being able to sell an investment quickly without a significant price reduction. Inflation risk, the risk that inflation will erode the purchasing power of returns. Interest rate risk, the risk that changes in interest rates will affect the value of investments. 4.4. The Capital Asset Pricing Model, KPM. CAPM is a financial model that describes the relationship between systematic risk and expected return for assets, particularly stocks. Key concepts include risk-free rate, the return on an investment with zero risk, typically government bonds. Beta, a measure of an asset's volatility relative to the market. Market risk premium, the additional return expected from holding a risky market portfolio instead of risk-free assets. Expected return, the return an investor anticipates based on the risk-free rate, beta, and market risk premium. 4.5. The Arbitrage Pricing Theory, APT. APT is an alternative to CAPM and assumes that asset returns can be predicted using a linear relationship between the asset and several macroeconomic factors. Key aspects include factor sensitivities. Each asset has sensitivities to various economic factors, for example, inflation, interest rates. No arbitrage condition. The theory assumes that arbitrage opportunities, risk-free profits, are not sustainable in the market. Multi-factor model. APT considers multiple factors to explain the return of an asset, unlike CAPM, which uses a single factor, market risk. 4.6. Portfolio management. Portfolio management involves selecting and managing a collection of investments to meet specific financial goals. It includes asset allocation, distributing investments across various asset classes, for example, equities, bonds, real estate, to balance risk and return. Diversification, reducing risk by spreading investments across different assets, sectors, or regions. Rebalancing, adjusting the portfolio periodically to maintain the desired asset allocation. Performance evaluation, assessing how well the portfolio meets the investment goals. 4.7. Investment styles. Investment styles refer to different strategies for selecting securities and managing portfolios. Common styles include growth investing, focusing on companies expected to grow faster than the market average. Value investing, seeking undervalued stocks that are trading below their intrinsic value. Income investing, prioritizing investments that provide regular income, such as dividends or interest. Index investing, replicating the performance of a market index, such as the S&P 500. 4.8. Single asset management, compared to a multi-manager approach. Single asset management involves managing all investments through a single manager or strategy. This approach can provide a more focused and cohesive strategy but may lack diversification. Multi-manager approach utilizes multiple managers or strategies to handle different parts of the portfolio. This can enhance diversification and reduce risk, but may involve higher costs and complexities in coordination. Learning Unit 5. Financial Markets, Capital and Money Markets. Introduction. This unit explores the structure and function of financial markets, focusing on capital and money markets. It explains the importance of capital markets, the key role players within them, and the characteristics of interest-bearing instruments like bonds. Additionally, it compares the risk and return profiles of bonds with other asset classes, covers the equity markets, and delves into the money market and its various instruments. 5.1. The case for capital markets. Capital markets are essential for economic growth as they facilitate the raising of long-term funds by businesses and governments. Capital raising. Companies and governments use capital markets to raise funds for expansion and development through issuing stocks and bonds. Investment opportunities. Capital markets provide investors with opportunities to invest in a wide range of financial instruments, contributing to wealth creation. Market efficiency. By providing a platform for buying and selling securities, capital markets help in the efficient allocation of resources. Economic stability. Well-functioning capital markets contribute to economic stability by channeling savings into productive investments. 5.2 Role players in the capital market. Key participants in the capital market include issuers, companies and governments that raise funds by issuing stocks, bonds, and other securities. Investors, individuals and institutions that buy securities to earn returns. Intermediaries, financial institutions like banks, brokers, and investment funds that facilitate transactions between issuers and investors. Regulators, government agencies that oversee and regulate the markets to ensure fairness, transparency, and stability. 5.3 Interest-bearing instruments. Bonds. Bonds are debt securities issued by corporations, municipalities, and governments to raise capital. Key features include fixed income. Bonds pay regular interest, coupon payments, to investors until maturity. Principal repayment. At maturity, the bond issuer repays the principal amount to the bondholder. Types of bonds. Bonds vary by issuer, maturity, interest rates, and risk level, including government bonds, corporate bonds, and municipal bonds. 5.4 The risk and return profile of bonds compared to other asset classes. Bonds offer a different risk and return profile compared to other asset classes. Lower risk. Bonds are generally considered less risky than stocks because they provide fixed interest payments and return of principal at maturity. Steady returns. Bonds offer predictable returns, making them suitable for conservative investors. Interest rate risk. The value of bonds is sensitive to changes in interest rates, with rising rates leading to lower bond prices. Inflation risk. Fixed rate bonds may lose purchasing power if inflation rises significantly. Comparison with other assets. Compared to equities, bonds typically offer lower returns but also lower volatility, making them a stabilizing force in a diversified portfolio. 5.5 Equity markets. Equity markets, or stock markets, are platforms where shares of publicly traded companies are bought and sold. Ownership. When investors buy shares, they acquire ownership in a company, with rights to a portion of its profits, dividends. Capital appreciation. Investors can earn returns through capital appreciation if the share price increases. Market dynamics. Equity markets are influenced by company performance, economic conditions, investor sentiment, and market trends. Volatility. Equities tend to be more volatile than bonds, with higher potential returns but also higher risk. 5.6 The money market. The money market deals with short-term debt instruments that provide liquidity to businesses, governments, and financial institutions. Short-term borrowing. The money market is used for borrowing and lending with maturities typically less than 1 year. Liquidity management. It helps organizations manage their short-term funding needs and maintain liquidity. Interest rates. Money market instruments usually offer lower returns compared to long-term investments, but are considered safe and highly liquid. 5.7 Types of money market instruments. Money market instruments are diverse, catering to different needs. Treasury bills. T-bills. Short-term government securities with maturities ranging from a few days to a year, sold at a discount and redeemed at face value. Commercial paper. Unsecured short-term debt issued by corporations to meet immediate financing needs. Certificates of deposit, CDs. Time deposits offered by banks with a fixed interest rate and maturity date. Repurchase agreements, repos. Short-term loans where a security is sold with an agreement to repurchase it at a higher price at a later date. Learning Unit 6, Collective Investment Schemes. Introduction. This unit focuses on collective investment schemes, CIS, which are pooled investment vehicles that allow multiple investors to combine their funds to invest in a diversified portfolio of assets. The unit covers the definition of CIS, common industry terms, the advantages of CIS, their structure, and relevant legislation. It also examines the differences between lump sum investments and phased or regular fixed investments. 6.1 Definition of a collective investment scheme. A collective investment scheme, CIS, is an investment vehicle that pools funds from multiple investors to invest in a diversified portfolio of assets managed by professional fund managers. Key features include pooled funds. Investors' money is combined to achieve economies of scale and diversify risk. Professional management. Fund managers make investment decisions on behalf of investors. Variety of assets. CIS can invest in various asset classes such as stocks, bonds, and real estate. Unit-based investment. Investors buy units in the scheme, with the value of units reflecting the value of the underlying assets. 6.2 common terms used in the collective investment schemes industry. Understanding key terminology is crucial in the CIS industry. Net asset value, NAV, the total value of the scheme's assets minus its liabilities, divided by the number of units outstanding. Units, shares of the CIS that investors purchase. The price of each unit reflects the NAV per unit. Portfolio, the collection of assets held by the CIS. Fund manager, the professional responsible for managing the CIS and making investment decisions. Dividend distribution, payments made to unit holders from the income generated by the CIS's investments. 6.3. The advantages of a collective investment scheme. CIS offers several benefits to investors. Diversification. By pooling funds, a CIS can invest in a broad range of assets, reducing the risk associated with individual investments. Professional management. Investors benefit from the expertise of professional fund managers who make informed investment decisions. Accessibility. CIS allows small investors to access markets and asset classes that might otherwise be out of reach. Liquidity. Units in a CIS can usually be bought and sold easily, providing liquidity to investors. Economies of scale. Pooling funds reduces transaction costs and can provide access to better investment opportunities. 6.4. The structure, elements of a collective investment scheme. The structure of a CIS typically includes the following elements. Fund manager, the entity responsible for making investment decisions and managing the portfolio. Trustee or custodian, an independent entity that holds the scheme's assets and ensures they are managed according to the fund's rules and regulations. Investor, the individual or entity that purchases units in the scheme. Regulator, the government body responsible for overseeing the CIS industry and ensuring compliance with relevant laws and regulations. 6.5 Legislation pertaining to collective investment schemes. CIS are subject to specific legislation that governs their operation, which may include regulatory framework, the legal structure under which CIS operate, ensuring they meet transparency, reporting, and conduct standards. Licensing requirements. Fund managers and trustees must be licensed and adhere to strict guidelines. Investment limits. Regulations may impose limits on how much can be invested in certain assets or asset classes to protect investors. Investor protection. Laws are in place to safeguard investors' interests, including disclosure requirements and fair dealing obligations. 6.6 Legislation and regulation of collective investment schemes. Regulation of CIS is designed to protect investors and ensure the integrity of the financial markets. Disclosure requirements. CIS must regularly disclose information about their investments, performance, fees, and risk to investors. Anti-money laundering, AML, compliance. CIS must adhere to AML laws, including verifying investors' identities and reporting suspicious activities. Risk management. CIS must implement robust risk management processes to identify, assess, and mitigate risks associated with their investments. Regulatory oversight. Regulators continuously monitor CIS to ensure compliance with laws and regulations, with the authority to enforce penalties for non-compliance. 6.7. Lump sum investments versus phasing in or regular fixed investments. Investors can choose between lump sum investments or phased regular fixed investments in a CIS. Lump sum investment involves investing a large amount of money at one time, which can lead to significant gains if market conditions are favorable, but also exposes the investor to greater market timing risk. Learning Unit 7, Alternative Investments. Introduction. This unit focuses on alternative investments, which differ from traditional asset classes like stocks and bonds. Alternative investments can offer diversification, potential for higher returns, and access to unique markets and strategies. The unit covers hedge funds, private equity, derivatives, commodities, and real estate, explaining their roles as asset classes and how they fit into an overall investment strategy. 7.1 Hedge funds. Hedge funds are pooled investment funds that employ various strategies to earn active returns for their investors. Investment strategies. Hedge funds may use strategies like long-short equity, market neutral, arbitrage, and a global macro to achieve returns. Leverage. Hedge funds often use borrowed money to amplify returns, which can also increase risk. Regulation. Hedge funds are typically less regulated than mutual funds, allowing for more flexible investment strategies, but also presenting higher risks. Accredited investors. Due to the higher risk and complexity, hedge funds are generally available only to accredited investors who meet certain income or net worth criteria. 7.2 Private equity as an alternative investment. Private equity involves investing directly in private companies or buying out public companies to take them private. Buyouts. Private equity firms often engage in leveraged buyouts, LBOs, where they acquire companies using a combination of equity and debt. Venture capital. A subset of private equity, venture capital focuses on investing in early-stage companies with high growth potential. Long-term horizon. Private equity investments typically have a long-term horizon, with returns realized through the sale or IPO of the company. Active management. Private equity investors often take an active role in managing the companies they invest in to improve performance and increase value. 7.3 Derivatives as an asset class. Derivatives are financial contracts whose value is derived from the performance of an underlying asset, index, or rate. Types of derivatives. Common derivatives include options, futures, forwards, and swaps, each serving different purposes in risk management or speculation. Hedging. Investors use derivatives to hedge against risks such as price fluctuations in commodities, interest rates, or currencies. Speculation. Some investors use derivatives to speculate on the future direction of markets, which can lead to significant gains or losses. Leverage. Like hedge funds, derivatives often involve leverage, amplifying both potential returns and risks. 7.4 Commodities as an asset class. Commodities include physical goods like metals, energy, and agricultural products that can be traded in financial markets. Types of commodities. Key categories include precious metals, gold, silver, energy, oil, natural gas, and agricultural products, wheat, coffee. Inflation hedge. Commodities can act as a hedge against inflation, as their prices often rise when inflation increases. Market volatility. Commodity prices can be highly volatile due to factors like supply and demand, geopolitical events, and natural disasters. Investment vehicles. Investors can gain exposure to commodities through direct investment, commodity-focused funds, or derivatives like futures contracts. 7.5 Real estate as an asset class. Real estate involves investing in physical properties or real estate-related securities. Types of real estate investments. These can include residential, commercial, and industrial properties, as well as real estate investment trusts, REITs. Income generation. Real estate can provide regular income through rent payments, as well as capital appreciation over time. Diversification. Real estate often has a low correlation with other asset classes, making it an effective tool for diversification. Risks. Real estate investments are subject to risks such as market fluctuations, interest rate changes, and the property-specific issues like vacancy rates. In summary, this unit provides an overview of alternative investments, highlighting their unique characteristics and potential benefits. It covers hedge funds, private equity, derivatives, commodities, and real estate, explaining how these asset classes can enhance a diversified investment portfolio and offering insights into their associated risks and opportunities. Thank you for watching.